Have you ever thought about what would happen if the American housing market collapses again, similar to the events of 2008? The housing market stands as a crucial component of the American economic mechanism. It forms a robust ecosystem, breathing life into numerous sectors ranging from construction to real estate, banking to interior design. When the housing market thrives, it resembles a shining sun on a clear day, warming the economy, generating employment, and fostering growth. However, when it weakens, the specter of recession looms large. Let's revisit the still haunting 2008 among economists and homeowners. The American housing market not only stumbled but collapsed, triggering a global financial crisis. Millions of Americans lost their homes, unemployment rates skyrocketed, and the world plunged into the most severe recession since the Great Depression. The 2008 housing crisis served as a stark reminder of the interconnectedness of our global economy. The collapse of the American housing market didn't just impact those residing within the U.S. It sent shockwaves through economies worldwide. Banks grappled with troubled debts globally. Currencies fluctuated wildly, and stock markets plummeted. It was a domino effect sparing no untouched sector. So why does this historic event matter now, 15 years later? Because history has a tendency to repeat itself, my friends. There are murmurs, whispers in the corridors of Wall Street, signaling another impending collapse on the horizon. It's not about spreading fear, it's about understanding the forces at play, recognizing the patterns that accelerated the collapse in 2008, and analyzing whether we're currently traversing a similar trajectory. It's about learning from our past to prepare for our future, so you might want to buckle up because we're about to delve into the depths of the impending housing market collapse. First and foremost, we need to grasp how the housing market operates. Like any market, the housing market is governed by the fundamental principles of supply and demand. When demand for housing exceeds supply, prices rise. Conversely, when there's an oversupply of existing homes compared to potential buyers, prices fall. These price fluctuations are unique to the market and are influenced by myriad factors, from local job markets to school districts and natural disasters. Interest rates also wield significant influence. They represent the cost of borrowing. When interest rates are low, borrowing money to purchase a home becomes cheaper, leading to increased demand and higher prices. Conversely, when interest rates rise, demand decreases and prices may fall. Another critical aspect to grasp is mortgage credit. A mortgage is a loan typically with a 25 to 30-year term, secured by the value of your home. Borrowers defaulting on their loans can accelerate serious economic repercussions, as witnessed in the 2008 housing market collapse. Finally, government policies such as tax incentives for homeowners and government-backed loans can influence the housing market in unforeseen ways. Armed with this foundational understanding, we can begin to unravel the factors contributing to a potential crash. Experts point to numerous warning signs indicating a downturn in the housing market. It indicates that a collapse in the housing market may be imminent. At the top of the list, we have unprecedented housing price inflation seen across the country. Prices have skyrocketed at a rate far outpacing income growth. Homes are now being sold at prices that many Americans simply cannot afford. This is a worrying trend reminiscent of the housing bubble that burst in 2008. If history is to be a guide, everything that goes up must eventually come down. And when housing prices are this high, the fall could be dramatic. Next, we are facing the specter of rising mortgage debt. Americans are taking on increasingly larger amounts of debt to finance their homes. The average American now has mortgage debt that is more than 3 times their annual income. This level of indebtedness is not only unsustainable, but dangerous. With people mired in such heavy debt, defaulting on their loans is not just a distant financial emergency. Finally, there's the broader issue of economic instability. Over the past few years, we've experienced a series of economic shocks, from trade wars to pandemics. These events can create uncertainty and volatility in the economy, negatively impacting the housing market. When people are unsure about their financial futures, they are less likely to take on the risk of buying a home. This could lead to a slowdown in the housing market, which could in turn trigger a collapse. In summary, inflated housing prices, high levels of mortgage debt, and economic instability are warning signs that a collapse in the housing market could be on the horizon. This is a scenario that has happened before, and if we're not careful, it could happen again. These warning signs indicate that we may be on the brink of another housing market collapse. The effects of a collapse in the housing market are not limited to just the housing market itself. Think of it as a row of falling dominoes. Each domino represents a sector of the economy. The first one, our focal point, is the housing market. Now imagine what happens when the first domino falls. It triggers a chain reaction where each domino knocks over the next. This is the domino effect of a housing market collapse, rippling through almost every corner of the economy. Let's start with the most immediately impacted domino, jobs. The housing market is a significant employer, from construction workers to real estate agents and home furnishing retailers. When the housing market collapses, jobs are often among the first casualties as people lose their livelihoods. They have less money to spend, which brings us to the next domino, consumer spending. Consumer spending is a significant driver of any economy. When people have less money, they spend less, and this decrease in spending can negatively impact businesses. Retailers sell fewer products, restaurants serve fewer customers, and before you know it, these businesses are struggling. Some may even have to close their doors, leading to further job losses. This spiraling domino effect can potentially lead us into a more severe economic downturn, namely a recession. During a downturn, economic activity slows, unemployment rises, and this becomes a self-perpetuating cycle of economic hardship. Let's not forget about the psychological effects. As people watch home values drop and job security diminish, consumer confidence can take a hit. This lack of confidence can further exacerbate the problem as people become more hesitant to spend money, invest, or take risks, slowing down economic growth even more. As you can see, the effects of a collapse in the housing market extend beyond homeowners or those working in the housing sector. The impact is felt across the entire economy, from the tallest skyscrapers on Wall Street to the smallest storefronts on Main Street. So what does a housing market collapse potentially mean for the average American? Let's delve deeper into this. The potential impact of a housing market collapse on the average Joe and Jane is significant and far-reaching. It's not just about numbers on a screen or economists rubbing their hands together in anticipation. It's about real people in their lives. Imagine this. You've worked hard, saved diligently, and finally bought a home. It's a tangible symbol of the American dream. But then the housing market crashes. The value of your biggest investment, your home, plummets. You owe more on your mortgage than your home is worth. It's like watching your hard-earned savings wash away in a flood and leaving you in a precarious financial situation. Now, let's say you lose your job or face financial hardship. You can't rely on your home as a financial safety net because its value has dropped. You're struggling to keep up with mortgage payments. This is where the term mortgage default comes into play. A horrifying scenario where you can't afford your mortgage and the bank steps in. You might have to sell your home at a loss, or worse, face foreclosure. But the dominoes don't stop falling there. Foreclosure or bankruptcy affects your credit score and makes it harder to obtain credit in the future. Rebuilding your credit can take years, sometimes even a decade. This means higher interest rates on credit cards, difficulty obtaining loans for a car or education, and even challenges in finding housing. And it's not just homeowners feeling the strain. As the rental market adjusts to the new reality, tenants may also face increased prices and instability. It paints a sobering picture, doesn't it? A collapse in the housing market doesn't just affect Wall Street or big banks. It literally hits home. Its impact on individuals and families can be devastating, and recovery can take years. That's why understanding the housing market and its potential pitfalls is crucial for everyone. So what can be done to prevent a collapse in the housing market? That's the burning question on everyone's minds. The truth is, prevention requires a collective effort from all parties involved in the housing market. First and foremost, let's talk about responsible lending practices. Financial institutions play a significant role in the housing market. They provide the capital that fuels real estate transactions. But these institutions are setting the stage for a housing collapse when they engage in reckless lending. Responsible lending practices involve thoroughly assessing the applicant's ability to repay the loan rather than indiscriminately lending to maximize short-term profits. Then we have government regulation. The government has the authority to create laws and regulations to stabilize the housing market. This may include implementing stricter credit criteria or controlling new housing supply to prevent oversupply that could lead to a collapse. The government can also regulate the rental market to ensure that rental prices are in line with average income streams and prevent an affordability crisis that could trigger a housing collapse. Lastly, we cannot overlook the role of individual financial responsibility. It's easy to get caught up in the excitement of buying a home, but living within your means is crucial. This means not taking out a mortgage you can't afford or buying a home as an investment with the expectation that prices will always rise. Remember, like any market, the housing market has its ups and downs. In conclusion, the key to preventing a collapse in the housing market lies in balance. Balance in lending practices, balance in government regulations, and balance in individual financial decisions. It's about understanding that the housing market is not just about making money, but also about providing stable and affordable housing for everyone. And remember, when it comes to the housing market, prevention is always better than cure. It's a shared responsibility that we all need to take seriously for our economy and communities. But what if it's too late for prevention? How can you prepare for a housing market collapse? Let's delve deeper into this issue, understanding that preparing for a housing market collapse is not about panic or pessimism. It's about common sense. It's about ensuring that you're not caught unprepared if there's a downturn in the market. First and foremost, consider diversifying your investments. If all your eggs are in the housing market basket, a collapse could be devastating. Diversification helps reduce risk. Think of it as not putting all your financial hopes on one horse. Look into other investment types like stocks, bonds, or mutual funds. Even investing in a small business or your education can be a form of diversification. Now let's talk about creating an emergency fund. This serves as a safety net that can help you weather financial storms. It's recommended to have at least 6 months' worth of living expenses saved up. This way, even if the market crashes and you lose your job or your property value drops, you have a cushion to fall back on. And finally, consider paying down your debt. High levels of debt can make it much harder to weather a downturn. If you have significant mortgage or credit card debt, a market downturn can make meeting your obligations even more challenging. So start chipping away at that debt now. It may seem daunting, but every bit helps. Remember, the issue isn't about predicting the exact movements of the market. Even the most seasoned economists can't do that consistently. It's about ensuring that you're in a strong position no matter what happens. It's about securing your financial future. We've discussed diversifying investments, creating an emergency fund, and paying down debt. These are strategies that can help you prepare for a possible collapse in the housing market. While we can't predict the future, we can certainly prepare for it. Another collapse in the housing market is certainly daunting. From understanding its fundamental structure to recognizing the warning signs of a potential collapse, we've examined the complex layers of the housing market. It's evident that a housing collapse's domino effect could be far-reaching and impact not only homeowners, but also the economy more broadly. The potential human cost is a serious consideration, as individuals could find themselves in precarious situations. But remember, knowledge is power. By understanding these dynamics, we can equip ourselves with strategies to prevent or at least mitigate the impact of a disaster. From policy changes to personal financial planning, we've explored some of these strategies today. So what does it all mean? It means that while the housing market may be unpredictable, our response to it doesn't have to be. While we may not control the market, we can control how we react to it. Let's hope for the best, but always be prepared for the worst.
At our channel, we delve into financial concepts in a way that everyone can comprehend and apply. We strive to empower our viewers with actionable insights to improve their financial well-being. Don't forget to subscribe, like, and leave your comments to support us on this journey toward financial empowerment. Additionally, it's important to note that while we provide examples and insights, our recommendations are not intended as personalized investment advice. Each individual's financial situation and goals vary, so it's crucial to conduct thorough research and consider professional guidance before making any investment decisions.